Today, with open enrollment right around the corner starting on November 1st, it is very important to understand inherently what your options are, and especially with regard to how powerful HSA accounts are. It's imperative that you know about these things and just how great they can be as an investing tool, but also an additional savings tool for what we all know and love, which are the increasing healthcare costs in the United States. But if you don't necessarily have a whole lot of healthcare expenses, or you want to be in a little bit tighter control and reduce your premium amounts for your healthcare plan, HSAs do offer a fantastic avenue for this. And we'll also go into a little bit of the history because it's important to understand as well what are HSA accounts and what they aren't, because there's a few different options out there that people, and I just talked to someone the other day, are kind of under the assumption that are HSAs, but they really aren't. So we'll do a little bit of history and then we'll dig into exactly what these accounts are, what they can cover, how you can utilize them, and how you can invest them. A little bit about myself. My name is Alex Perny. I've been with Advanta IRA since 2012. I deal a lot with healthcare savings accounts. For whatever reason, here at Advanta, I tend to be the one that fields a lot of these questions, but not to say that all of my colleagues aren't very capable of answering your questions as well if you've been dealing with someone else. But I do really enjoy these types of plans. I personally self-direct my own HSA, and I really do believe in the power of these things to help people out. So if you have any questions or you want to get some additional information, please feel free to reach out to me directly. I'm always happy to help. Now, it's important that we kind of delineate what exactly we do and don't do here at Advanta, especially when talking about two things. One, tax planning, and the second being choosing things to do with your healthcare. It's important that you understand what we do and don't do. Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment, or more specifically, deciding which type of healthcare plan to decide on as well. So what is an HSA? It's important to understand what this is, and we're going to compare and contrast them to a few other different types of healthcare accounts that are out there, so you understand while you may be saving for healthcare and you might have an account that is utilized for healthcare savings, it is not a health savings account. I know a lot of these acronyms are going to get a little bit confusing, and there's a lot kind of being thrown at people, but suffice it to say, if you want more information, it's best to reach out. And also, I'm going to be referring to things called high deductible healthcare plans, and to truncate that a little bit, I'll just be referring to HDHPs, which are the type of healthcare plan that you have to have in order to have an HSA. Because just because you have something, and inherently most of them do have relatively high deductibles, they don't necessarily all qualify. And I'll go into some of the legislative issues that kind of come in and make some of them non-qualifying HSAs, or not qualify for HSAs. But what is an HSA? An HSA is a tax advantage savings account for individuals with HDHP plans that can be used for a wide variety of future medical expenses. And in some cases can be used for personal expenses as well once you reach a certain age. So we'll get into that in a little bit. But let's go through the history of this a little bit, because there are some things that have been phased out. There are some things that are still in existence. And it's kind of important to understand where all this stuff falls when it comes to deciding which one to go with. So back in 1984, we have kind of the initial genesis of what's going to become the HSA being put out there, because the United States government recognized that there was a need to reduce the amount of reliance on Medicare, Medicaid, and Social Security, and to try to give people additional tax incentives to save for their own healthcare costs. So in 1996, we kind of have Congress's first stab at this, which is the Archer MSA. So this is kind of the forerunner to flex spending accounts, health reimbursement accounts, and HSAs, which we'll be covering in more depth today. But this essentially is plans that were established by employers, which were subject to payroll and income tax to the employees, and monies could not be rolled over year to year. So it was kind of a first good effort, and then there were adjustments later on to make these plans tax-free. So now we have about 6 years until we get some more progress made on what will be, again, coming into the realm of HSAs. The Treasury Department ruled that health reimbursement accounts can be rolled over from year to year, but the employee who lost that employer would have lost that balance. So when we talk about FSAs, so flex spending accounts, and HRAs, those types of plans cannot be rolled over from employer to employer. Those are the kind of savings accounts, if you will, that you use or lose. So a lot of people might be familiar with that when selecting a healthcare plan at a particular employer. that you get a little bit of money put into an account that you either might get a check ripped from the healthcare provider, or you might just use for things like prescriptions and the like. Now, those can be HSAs, but most often than not, they are flex spending accounts or health reimbursement accounts, and those types of balances are not portable from employer to employer, which what HSAs are. So in 2023, HSA, or 2003, my apologies, HSAs are created to allow for portability. So you have a job that had provided you with HSA qualifying coverage, you contributed money in there, or your employer contributed on your behalf. Now, when you leave that company, now you can take those funds with you and either attach that HSA to another high deductible healthcare plan, or continue to grow and invest those funds and then reimburse yourself from previous expenses, or in the future, and like we'll get into, the be able to use those funds personally. So the Archer MSA, which I don't even know if I've actually seen one in the past 6 or 7 years, still in existence. Like I said, the Archer was phased out, but for those of you that might be a little bit older and have been saving for healthcare expenses for a while, just understanding where those plans come in. They were created in '96. They expired in 2005, which again, if you still have one, that's great, but I don't think many people would really have one anymore, but it's important to understand kind of the genesis of where these things come into. So flex spending accounts are still in existence, and they are very common with healthcare plan providers to offer a more affordable option for their participants in that healthcare plan. Now, flex spending accounts do run in a very analogous fashion to HSAs insofar as that it is a block of cash that is contributed into an account that can be used for discretionary healthcare costs. Now, what that means is there are certain types of expenses you cannot reimburse yourself from, like the mileage to get to your doctors. You can't use your FSA to put gas into your car to get to a like preventative care appointment. You can't necessarily use it for cosmetic procedures, things like that. But again, it is a flexible spending account insofar as that it allows you to pay for expenses that are not directly covered by your healthcare provider. Now, under the Affordable Care Act, more commonly known as Obamacare, you can carry over up to $500 year to year from these plans. But the downside is that if you had a contribution of, let's say, $3,000, which would roughly be the contributory maximum for one of those plans, and you only spent, let's say, $500, the next year you would only be able to roll over $500, and you would lose $2,500 of money within that. It would just go back into the employer or the healthcare plan provider's pocket. So while these do offer, again, a higher degree of flexibility and potentially lower premiums, they are relatively restrictive in the fact that you cannot move them from employer to employer. It is a use or lose type situation with these things, and you have very little control over how these plans are invested, or even if you can make any discretionary investment decisions on a flex spending account directly. I am not aware of anywhere that offers one that allows for discretionary investments with those. They mainly are just a cash account. Think about it like a managed checking account for healthcare expenses. So that's just something to be aware of. Now, flex spending accounts inherently are different from HSAs. I know, again, the analogies here are running rampant, but with a flex spending account or FSA, and they're also called HRAs, health reimbursement accounts, they are a savings account for healthcare, but they are not a health savings account. Again, I know there's a lot of analogies being thrown around, but it is something to consider. Now, what are some of the benefits of an HSA account as they relate to FSAs? Well, what the government's doing with these types of healthcare accounts is they're encouraging better healthcare spending habits, and ideally the amount they can reduce the reliance on things like Medicare, Medicaid, and Social Security, the better off those programs are going to be. And again, offering an additional benefit for tax savings and tax deferred or tax-free investment growth as well is a nice benefit that they're giving. So the thought is that if you spend your own money, you will do more research on what you are purchasing and make better decisions. Now, this could be true or not true. I know that people often say, well, I'm having to decide on something that I kind of need, but the insurance company isn't necessarily covering. We're not here to pass judgment on any particular type of issues with healthcare in the United States, but again, these are kind of the overlying thoughts and theories on why these things are out there and ultimately what they're trying to accomplish. Really, the biggest benefit that it's giving you is a reduction in premiums, because HSA qualifying HDHPs, healthcare plans that qualify for HSA accounts, are going to have lower premiums They're going to have higher out-of-pocket expenses, but it's going to, one, allow you to save money if you're relatively healthy and don't need a lot of procedures, and also allow you another avenue to invest in additional tax savings as well. Now, these are just for health expenses. Once you reach the age of 65, you can treat it like a traditional IRA. But again, up until the age that you're 65, you have to use these accounts for healthcare related expenses only, and only healthcare related expenses that were incurred or not paid out by any other insurance. So basically only healthcare expenses that were incurred while the HDHP was in existence. So it's supplemental to your healthcare insurance coverage. It is not to supplant it, it is to supplement, meaning that this goes along with having the qualifying type of healthcare insurance. So not everyone can just have one of these types of plans. Let's see. Okay, we've got a question. We'll get through this slide and then we'll answer that. So the great things about these types of plans are that you get deductions going in like a traditional IRA, and you get tax-free growth on your investments like a Roth IRA. Again, you get the best of both worlds with these accounts, which are one thing I really, really like about it. You get, again, the tax-free distributions for qualifying medical expenses, and you can reimburse yourself in perpetuity so long as you have not had those expenses covered by another healthcare provider or healthcare insurance provider. You can reimburse yourself, so long as you're still alive, you can reimburse yourself. So you don't have to deplete these accounts. You can continue to roll them over, continue to grow them, and then enjoy either tax deferred or tax-free distributions, depending on one, your age, and two, what the distribution was for. So what exactly is the question pertaining to? The question is, I have two HSAs, one from a current employer and another from a previous employer at the same previous provider at the same employer. Am I able to roll over HSA accounts and self-direct, but still have the HSA at the employer for the current one? Typically, yes, your HSA account is going to be portable to wherever you would like it, because they're just going to run payroll deferrals to the bank that they utilize for the HSA. Now, specifically, if it's provided by the employer, if they're making the contributions, sometimes and more often than not, those are going to be FSAs, flex spending account. If those accounts essentially do not deplete at year's end, then they would probably be an HSA. Now, if you had these two HSAs, one, you need to make sure they're the same type of HSA, because there's family HSAs and there are individual HSAs. You couldn't necessarily combine the funds from both of those into one, because you have to make sure that you're attributing the distributions from one to expenses only incurred by the participant when they had the qualifying coverage. Again, I know this is kind of a lot to throw at people, but it's important and the details are specific. But hey, nothing with related to healthcare is easy, so I guess I don't feel that bad. So they're both, okay, the individuals, so they're both family HSAs. If they are both family HSAs, then yes, you could roll them over and self-direct both of them. You could combine them into one family HSA plan and then self-direct that HSA directly. You would need to essentially make sure that you are, again, only utilizing the reimbursement function for the correct type of reimbursements, but there shouldn't be any restriction on you moving those funds to where you want to, because the employer, if they are making contributions on your behalf, would still make them to the same bank. You wouldn't necessarily close it out. You would do a transfer of the assets of each of those plans into a self-directed HSA and then move forward, and then keep that other bank open for them to make the HSA payroll deferrals into there. Now, some employers don't mind where you do it, but most of the time they're not going to want to set up a separate payroll to do something to like an Advanta HSA, if you will. But again, that's kind of the best answer that I can give to that question. But again, great question. Keep them coming in and we will address them as they come up. So let's look at some of the examples of the benefits of an HSA. Remember, HSA contributions are tax deductible, only if you make them though. So if your employer is making one on your behalf, you don't get to claim that tax deduction. It would be nice, but unfortunately you can't. I really wish that was the case, but again, we can't always have our cake and eat it too. So let's say you have an HSA, right? You contribute $3,550 of earnings to an HSA and you get a deduction on your tax return. At a 20% tax bracket, that's a $710 savings. You can now distribute $3,550 tax-free to pay for healthcare expenses. So let's say you had a $3,550 bill for something that you needed to pay. You could contribute that to an HSA, write off that amount of tax savings, so you get reduction on how much money you have to pay in taxes of that, and then you could immediately distribute it to pay for those tax expenses. And then any unused funds would grow tax-free. So that's a great example of the benefit of an HSA. Now let's look at the same example by not using an HSA. Let's say you use $3,550 out of pocket. So you paid after tax with this. You would have to have $4,400 of earnings, again, paying 20% taxes, to actually end up with $3,550. So again, in these two exact same examples, if you just contributed that same $3,550 to an HSA, you save $710 in taxes. And again, it's immediate. You can turn around, do this, and distribute it and reimburse yourself, as opposed to having to have the same amount of after-tax income, having to have $4,400 of earnings. Now, again, you can extrapolate this as much as you want. If you got a $20,000 bill, 30, 50, and you had the money in the HSA to cover that, granted, you can't just make that as a contribution to the HSA in one shot. But again, it goes to show just how, easy and powerful these tools can be, or I should say how powerful, maybe not necessarily easy because it is a little bit complicated, but again, I think it goes to show very well just how nice that that plays out for people. So there's two types of HSA accounts. There's individual HSAs and family HSAs. And they are basically exactly what they sound like. An HSA plan, which is what I personally have and personally self-direct, covers one individual with a solo healthcare plan. So to use my personal example, because I think I know my life relatively well, I'm married and my spouse and I each have our own individual healthcare plans through our employers. Now, it's cheaper for us to do this. We get good coverage, but I elected to go with an HSA plan. So my HSA plan can cover expenses related only to my healthcare. So if my spouse had an expense, I couldn't use money in my HSA to cover that because it is not underneath of my healthcare plan. Now, self-only coverage deductible limit must be at least $1,500, and my out-of-pocket maximum has to be at least $7,500. Now, I know a lot of people are thinking, well, hey, my healthcare plan has these. Well, high deductible healthcare plans are not all created equal. You may very well have a coverage plan that meets these criteria for either family or individuals, but it doesn't necessarily qualify for HSA coverage, and we'll get into that in a moment. But with a family HSA, again, it's kind of what it sounds like. If you have a healthcare plan that covers you and your spouse or you and your children, then you could utilize the funds within that health savings account to reimburse yourself for expenses for anyone in that family household. But again, you need to make sure that if you have self-only coverage, you can't use it to reimburse yourself for an expense that, let's say, a spouse or a dependent had if they are not covered by that plan that would allow you to have the HSA in the first place. And you also have to track timing. If you were covered under another plan and then you have different healthcare coverage, and let's say it's family coverage and you had a family plan before, you can't reimburse yourself for out-of-pocket expenses under that previous plan either. So a lot to take in, but on the top down, looking at these is that individuals cover individual expenses for individual healthcare plans, family cover whoever is covered under that umbrella, whether that be you, your spouse, or your children under that plan. You can utilize those plans for that. Now, family only deductible coverage must be at least $3,000, and the out-of-pocket expenses maximum must be at least $15,000 for HSA healthcare coverage to be in effect. But again, we'll get into some of the things that are ancillary to that would preclude just a plan on face value having these out-of-pocket and deductible limitations that would preclude something like this from being able to have HSA coverage. Good question, good time to answer one. Let's see, are there any HSA plans that are not employer specific? Well, absolutely. If you purchase healthcare on the Affordable Care marketplace coverage, and you buy HSA qualifying coverage, then absolutely, you don't have to get healthcare provided by an employer. You could certainly have healthcare that was provided on an open marketplace that meets the criteria for HSA and then have an HSA. HSA plans, again, they're not tied to the employer in the sense like an FSA or health flex spending account would be, in that if you terminate employment, you get to keep all the money that's in that plan. An employer can contribute into that HSA on your behalf if they are sponsoring the healthcare plan, but it's not necessarily, the HSA isn't inherently tied to the employer per se. It is always your account that they may participate in contributing into. So I hope that addresses that question specifically. Requirements for HSAs. All right, let's dig into it. So you cannot have a copay for office visits other than preventative care, annual physicals, prenatal, well child, immunizations, and certain screenings, or prescription drugs until you meet your deductible. So that is the big key that most things in the Affordable Care Act they restricted HSA plans quite a bit, because before the ACA, you could have, that was written in by the Affordable Care Act, is that the copay aspect is one that precludes things from having a HSA plan attached to them. So while you certainly may very well meet the out-of-pocket maximum and the deductible limitation, so the $1,500 or the $7,500 for out-of-pocket and deductible, or the $3,300 and the $15,000 for the family coverage for deductible and out-of-pocket, if you do have a copay for a regular office visit, other than the ones I just mentioned, and prescription drugs, that would be a preclusionary item for it being qualifying HDHP coverage, so qualifying for HSA coverage. So that's an important thing to understand, is that while looking at numbers certainly, again, can make sense, and you can just correlate that to the healthcare plan that you have, the best way to figure out if this is HSA coverage, I know it sounds kind of like a cheap answer, is just to call your healthcare provider. So call Humana, call Blue Cross Blue Shield, and ask if it's HSA qualifying coverage. They'll be able to tell you much easier than you trying to figure it out on your own. Granted, calling a healthcare provider can be a painful experience, but at the end of the day, that's what I tell everyone, is contact your healthcare provider and ask if it's HSA qualifying coverage. Now, the marketplace has gotten a lot better with identifying specifically what is HSA qualifying coverage, and also employers, when they provide open enrollment packets for healthcare options, they have gotten a lot better at identifying which ones are HSA plans. So again, take that for what it's worth. I know specifically from looking at my spouse's and looking at mine, they're relatively well identified, but if you're not sure and you currently have a healthcare plan, it's best just to call your provider and ask if it's HSA qualifying coverage. But it's important to understand some of the other limitations in here. Number two, you cannot have other healthcare coverage, with the exception of vision, dental, workers' comp, or long-term disability insurance. So you can't have two different healthcare plans covering you and have HSA qualifying coverage. So if you had your own, let's say, HSA qualifying plan at your employer, and then your spouse also had a healthcare plan that you were participating in, you couldn't open up an HSA. So you have to keep in mind is that when you're planning out and trying to strategize for utilizing these types of accounts, making sure you don't have additional coverages that might preclude you from being able to have an HSA in the first place. You cannot be enrolled in Medicare. So if you are reaching the age of retirement and you want to enroll in Medicare, you cannot establish an HSA at that point. That doesn't mean you cannot have one previously. So let's say you had been saving for healthcare expenses for many years, you had plugged away, and you reached the age at which you want to enroll in Medicare. You don't have to distribute that entire account. You can just no longer use it for future medical expenses. You can treat it as a savings account or a reimbursement account for previously non-reimbursed expenses, or if you're over the age of 65 and you've enrolled in Medicare, you can treat it as a traditional IRA as well. And we'll get into a little bit more of what that looks like in a minute. But the Medicare one's one that comes up quite often because people are interested in additional tax savings plans, but if you are enrolled in Medicare, you cannot establish an HSA against that, even if you do have multiple coverages, because it goes back into the multiple coverage exemption for that. And you can also not be claimed or listed as someone else's dependent. So especially with individuals that are getting up into their 20s, getting to be 27, and with certain healthcare plans that can be even older that you're still covered or still claimed as a dependent, you cannot be claimed as a dependent and establish an HSA account. Not necessarily something that crops up too terribly often, but with financial literacy getting much better among the populace, people are starting to be younger and be more intrigued by these types of plans. Now, one really important thing that I like to bring up, again, what is healthcare and government without a bunch of rules that you have to remember, but this one is kind of interesting. And this is why we like to do this webinar around open enrollment, is that you have to bind coverage by a certain date in order to qualify yourself for being able to make a contribution for this year. It's called the first day of the last month rule. It means that you have to have your coverage bound, the qualifying HDHP coverage, so the HSA coverage for your healthcare has to be bound and in effect by 12/1, the first day of the last month, in order to be able to make a contribution, a full contribution for this calendar year. Now, HSA contributions can be made up until your tax filing deadline, your timely tax filing deadline. So if you filed an extension, sorry, it doesn't matter. April 15th is the next available filing business day is when you have to make your contributions, and they can be for 2023, but you have to have had that coverage bound and in effect by 12/1 in order to be able to make a full contribution for this year. And you have to keep that contribution in that account for a rolling 12 months, and you have to keep that coverage in effect for a full 12 months in order for you not to have to take a prorated distribution of that contribution. So what does that mean? That means that if you bind coverage by 12/1, you have to maintain coverage through the end of the following year in order for that HSA to kind of lock itself into place. I know it's a little bit of a squirrely rule, but think about it like this. Ben enrolls in a high deductible healthcare plan by 11/30/2023. He can contribute $3,850 to his HSA account for 2022. Need to change that date for 2023. If Ben loses his high deductible healthcare plan coverage prior to 11/30/2024, he must take a prorated distribution from the HSA account, basically taking the amount of distribution divided over the number of months, and the number of months that he wasn't covered, he has to distribute out of that plan. And this distribution is subject to taxes and a 10% penalty. So again, there's a lot of stuff that goes into this, but the short and sweet of it is that in order to be able to make a contribution for the full contribution for a given year, you have to have the HDHP in place by 12/1 of that given year. You have up until April 15th to make the contribution for the previous year, and you have to keep that coverage intact for a full rolling 12 months in order to not have to take a prorated distribution and pay 10% penalty and taxes on that pro rata distribution. Contributing to HSAs. Contributions must be made in cash. You can't contribute gold coins, you can't contribute a piece of real estate, you can't contribute anything. It has to be cold hard US dollars cash. Doesn't mean you have to go down to the bank and get a bunch of actual cash. You can make an ACH deposit or a wire, but again, it has to be made in cash for the contributions to these. And it can be participated in on behalf of an employer. They can kick in cash to one of these types of plans on your behalf, but remember, you cannot write off their contributions into the plan as tax deductible. You can do a one-time rollover from a traditional or Roth IRA to an HSA, but it is subject to the annual contribution limits, and you cannot use SEP or simple funds for this, meaning that if you want to make your annual contribution to one, you can roll over from a traditional or Roth. Most of the time, you're going to kind of lose out on the tax. You're going to lose out on the tax benefit because you can't write it off twice. So, unless you're in a position where you really are in need of doing that, most people get a better shake if they do it personally, so that way you get the tax write-off of contributing those funds into the plan. Again, everyone is different. When it comes to contributing or making any type of tax decision, make sure you check with a CPA, tax advisor, someone that can advise you and say, hey, this is the best route forward for you. Now, again, contributions can be made by an employee or an employer on behalf of the employee. Employee contributions are tax deductible. Employer contributions are not included in the employee's income. So if they are making a contribution on your behalf, it's not as if you are getting a reduction in shown income. It's just a benefit that they're offering to you. Certain employers do that. They want to have a good employee benefit package, they may do that. But keep in mind, it's not like participating in a 401k where you're deferring income to the plan. In this case, if an employer is electing to participate in an HSA with you, they're just making that out of a employee benefit package. They're not necessarily reducing your shown income for that. Deductions for these can be taken even if you don't itemize. And with the increase in the standard deduction that happened back in 2018, that's good for a lot of people because the standard deduction became immeasurably more popular for people instead of people needing to itemize their tax returns. So even if you don't itemize, you can still write off your HSA contributions, whether that be family or individual, and contributions, again, can be made up to your tax filing date, but your timely tax filing date, April 15th is the applicable date. You cannot contribute for a previous year to an HSA with an extended filing deadline. 2023 contribution limits for these things, they are $3,850 if you are a self-only plan coverage, and $7,750 of contribution limits if you are covered by a family. If you're over the age of 55, you can make $1,000 catch-up contribution, and also if you're legally married with if you're legally married with a family HSA, you both can make the $1,000 catch-up contribution to the plan. So again, not too terribly high of contribution limits, but keep in mind is that I would tell people to look at it in the ratio of what's the worst case scenario with your HSA. You have an out-of-pocket maximum for these things, and so long as that you are relatively healthy, these plans are a fantastic tax saving tool for most people, and monetary savings tool as well, because even if the worst happens, and so long as you have enough in the HSA to cover up until your out-of-pocket maximum, essentially you would have saved for it and then really would be paying nothing out of pocket, because the HSA could cover everything that was going up until the out-of-pocket maximum, and then the healthcare plan would then be providing 100% coverage for any medical expense thereafter. So granted, contribution limits aren't the highest thing in the world, but it does give you a good jumping off point. And again, you can use these funds in perpetuity to reimburse yourself for past medical expenses that were incurred while you had a high deductible healthcare plan in effect. Now, I've mentioned things like qualified medical expenses. What are qualifying medical expenses? Healthcare plan deductibles are the cost of doctor's visits, dental care, so long as that, again, they are not covered by another insurance provider, vision care, exams, glasses, contacts, surgery, medications, prescriptions, prescribed OTC meds. So a good example, I'll pick on ibuprofen, Motrin, if you will, for the name brand. If you are written a prescription for prescription ibuprofen, you can use HSA funds to go buy ibuprofen over the counter. If you are not, and let's just say you're like me and decide that training jujitsu and weightlifting is a great idea, and you get injured and stuff, and you need ibuprofen to make sure you can sleep at night, then I can't. I can't use my HSA funds to inherently cover that expense just for that OTC medication that I wasn't prescribed. So keep in mind, there's definitely plenty of them out there, things like Pepcid, allergy medications, anti-inflammatories that can be prescribed and are over the counter. You can use those funds in order to reimburse yourself for those. But again, if it's not, you can't do it. Chiropractors, you can use that HSA funds for chiropractors, bandages and first aid kits. Disabled dependent care expenses. Another big one is capital improvements to a home with the main purpose of medical care. So think about it like this. Let's say you end up in a wheelchair, or you need lower sinks, or you need some type of additional vision care and talk to text or speech to text phones or something like that. You can use HSA funds for that. You can also use it for long-term care, and a big one is you can use it for lodging and trip expenses for medical care. So an example would be, let's say you need to travel for oncology care in another state. If you live in Florida and need to go to, let's say, the Mayo Clinic somewhere, or something to that effect, you can use HSA funds if you are, again, still covered by the high deductible healthcare plan for paying for lodging and expenses related to getting that medical care, which is, again, a very big one, because not only is medical care expensive, but if you have to travel, it gets exponentially more expensive. So having a tool where you can utilize tax advantage savings to also reimburse yourself for out-of-pocket expenses that, let's say, may not necessarily be covered by your healthcare provider, because a health insurance company is not going to pay for a plane ticket to get to your coverage. They're going to get to your procedure, they're going to pay for the procedure. So again, this gives you a lot of flexibility in what you're actually paying expenses related to. And again, it's not just simply going to the doctor, emergency room visits, fixing a broken bone. It can be things like prescriptions, OTC prescriptions, chiropractors, lodging, and medical expenses. Now, I know that's a lot to take in. What I would recommend, if you want to get a good list of everything, check out IRS Publication 502. They list everything, and it is in alphabetical order, starting with A through Z. So if you're curious to know about what a qualifying medical expense is that you can utilize to reimburse yourself with tax-free out of an HSA, check out IRS Pub 502. For the most part, the IRS is not known for writing very engaging literature, but if you're just looking for a list, it's a good one, easy enough to understand and get through. So what are non-qualifying medical expenses? Healthcare plan premiums, except for COBRA, non-prescription drugs, weight loss programs, if it's cosmetic in nature. So think things like liposuction, but things like bariatric surgery, if it is medically necessary. Again, that kind of is the whole back and forth with figuring out what is medically necessary and what is qualifying expenses. Again, something to ask your healthcare plan provider, but think about, again, things like bariatric surgery to prevent or diagnose a disease, cosmetic surgery. So a good example would be a rhinoplasty, which is surgery on your nose for cosmetic reasons versus one to fix a deviated septum. That's kind of one of those ones where it would depend on the nature of the procedure on whether or not you could reimburse yourself from an HSA plan for one of those. Teeth whitening, nutritional supplements, cosmetic, hygienes, babysitting, healthcare club dues, or medical expenses reimbursed by an FSA or medical savings account, or payment for future medical expenses. HSAs can only be used for reimbursement or point of procedure expenses. So if you go into your dermatologist and you want to pay for something that they're doing right then, great, you can do that. But if they are asking, they would like to do some type of medical removal for some type of skin issue, you couldn't prepay that. They give you a bill, you can't prepay for the procedure in 3 weeks. You would have to pay after the procedure is done. Again, kind of makes sense. You can't reimburse yourself for future medical expenses with these. It has to be incurred, and then you reimburse or use a point of sale type transaction in order to pay for the expense. Now, I mentioned you can reimburse yourself in perpetuity for expenses that are incurred while you have an HDHP. And we'll get into kind of maybe the reasoning that you would want to do that here in a minute. But again, because you can do this essentially as far into the future as you want, you're responsible for keeping records. You have to keep records of the medical expenses, which again can be kind of a pain. But if you want to reimburse yourself and take a tax-free distribution from a tax qualified account 20 years in the future, the IRS might have a question if you're not paying taxes on, let's say, $20,000 of reimbursed medical expenses. So keep in mind that while you don't have any time frame for necessarily having to reimburse yourself, so let's say you went in and had some type of procedure done in January, you don't have to reimburse yourself by December 31st. You could, if it was January 2023, you could reimburse yourself in 2030 and enjoy the tax advantaged earnings within that plan to try to help bolster that kind of hybrid health savings retirement plan that you have going on. You're under no obligation to distribute or reimburse yourself in the calendar year in which the expense was incurred, or to that effect by your filing deadline either. Again, the qualifying medical expense had not been previously paid or reimbursed from another source, and the medical expense has not been taken as an itemized deduction in any year. So if you itemize your deduction, if you had a sizable out-of-pocket medical expense, and then you decided to write that off on your taxes because you were an itemized filer, you couldn't then in turn utilize an HSA plan to reimburse yourself from that expense. So there has to be some forethought into this. If it's a better shake for you to itemize that expense out on your tax return, well, then just keep in mind that it's going to preclude you from reimbursing yourself from an HSA account at a later date. But again, record keeping is key with this, especially if you're going to be going out into the future and reimbursing yourself down the road. So what do distribution from HSAs look like? You can take the distribution at any time after the expenses have occurred. HSA distributions are tax-free regardless of age or how long the plan has been in existence, as long as these requirements are met. Distributions are for qualified medical expenses, and expenses are incurred after the HSA is established. So with that said, if you establish the HSA December 1st for the first day of the last month rule, and you had some type of procedure or medical expenses in September, sorry, even if it was with an HSA qualifying plan, you have to have the HSA in effect in order for that qualification to be met. So the HSA has to at least be in existence with something in it in order for the other criteria to hold true. So keep in mind that if you're interested in doing this, at least opening one up and having some money in there, so that way you have the option for future contributions or future reimbursements not to be automatically precluded just because the plan, wasn't in existence, if you will. So let's look at what this kind of stuff looks like through the years. So going back to 2017, let's say Joe opens a self-only HSA and for that year made a $3,400 deductible contribution. He has $1,000 of qualifying medical expenses from May through December of 2017, and at the end of the year takes a $1,000 distribution from the HSA tax-free. The remaining $2,400 plus any accrued earnings remain in the HSA for future expenses. So, wrote off $3,400 on his taxes in 17, took a $1,000 distribution, paid no taxes, got the full $3,400 write-off, $2,400 is left in there. Now in 2018, makes another $3,400 contribution to the HSA. Has surgery costing him $3,000 out of pocket. He takes an immediate distribution to pay expenses, so he's left with $2,800 in the HSA account, and he accumulates some more expenses as well. At the start of 19, Joe has $2,800 plus some accrued earnings in the HSA, and he accrued another $500 of medical expenses, but doesn't take a reimbursement. So again, doesn't take a reimbursement for any of this. And then in January 2020, he makes a $3,400 deductible contribution to the HSA as well. And again, he just continues to accrue some, average amount of medical expenses throughout the years, but isn't taking distributions for them. So in 2020, Joe has $6,200 of earnings in his HSA, $6,200 plus earnings in the HSA, and $1,500 of expenses. Joe again makes his annual contribution, accumulates $1,000 or so in expenses, and takes no distribution from the HSA. So now let's fast forward to 2030. At the beginning of this year, Joe has $60,000 in his HSA, contributions plus earnings, in the last 12 years. He has had $20,000 of qualifying medical expenses, but took no distributions. He takes $20,000 tax-free from the HSA. So in 2030, he had just eaten those costs over years, had continued to save and invest and not pay any taxes on those investment returns in the HSA, and decides to take a $20,000 tax-free distribution from the HSA in 2030. And then in 2031, Joe decides he wants to remove some funds from his HSA, but has no more qualified medical expenses. What are the options? Well, if Joe's under the age of 65, the distributions from the HSA are subject to income tax and a 20% penalty. If Joe is over 65 or has become fully disabled, the 20% penalty does not apply, but the non-qualified distribution is subject to income tax. Now, what does that mean? That means when you turn 65 or if you become disabled, you can treat an HSA like a traditional IRA. Granted, you cannot roll the HSA funds into your traditional IRA, but after the age of 65, you can essentially treat this either as a Roth IRA for reimbursing yourself for medical expenses, qualifying medical expenses, or you can treat it as a traditional IRA for any other type of expense that you want to do. If you want to take a vacation, if you want to put a new roof on your house, if you want to buy a Mazda Miata, whatever you want to do with it, you can treat it as a traditional IRA and just pay tax on the distributions once you're over 65, which again, this is how these things kind of play into being a hybrid retirement account. Granted, they are essentially established for the use of medical expense reimbursement, but once you reach a certain age, and especially let's say if you are then in turn covered by something like Medicare, you can just treat it as an additional traditional IRA that you have. And assuming that you have no medical expenses that you want to reimburse yourself from. So again, these things don't necessarily have a timeline on when you have to distribute them, but the beneficiary options for these are relatively limited. If you name a spouse as the beneficiary of an HSA, then that spouse can treat it as their own HSA and use for qualifying medical expenses. However, for anyone else, it has to be a legally married spouse at the time of your death that is named as the primary beneficiary. For non-spouse beneficiaries, the HSA ceases to be an HSA account and the value of the HSA is taxable to your beneficiary in the year that you die. So it is basically included in the value of probate and your final tax and taxable to them in their tax return. If your estate is the beneficiary, then the value of the HSA is included in your final income tax return. So with that said, granted, you don't necessarily have to distribute these, but it's not necessarily something that ports very well to non-spousal beneficiaries. So take that for what it's worth. Some people, when they are getting an age or their spouse is no longer with them or they have divorced, there might be some incentive to distribute these at a quicker rate than any other type of plan because, again, the beneficiary options for these are extremely limited. So how can you invest HSA funds? the fun part of all this. So with an account like an Advanta IRA HSA, you can invest in basically anything that is not on a publicly traded stock market. And rarely do any other investment firms offer HSAs that can invest in securities either. Some companies just don't even offer them. I think big wirehouses too. But essentially here, you can invest in really anything that you would like to with an HSA. I've seen people that have had multiple rental properties in their HSA getting into the hundreds of thousands of dollars of value and tens of thousands of dollars in monthly rental income coming back into an HSA plan. Again, they're paying zero tax on any of that, and they pay no tax on any distributions made as well if they want to reimburse themselves for medical expenses. So the power of these plans is immeasurable, especially when you put it in context of the investment options that you have to invest these, especially in a self-directed fashion. There are certain things you can't invest in HSA with. You can't buy a life insurance policy with an HSA, and you can't invest in anything that derives its value from collectability. So think antiques, rare bottles of wine, artwork, stamps. You can buy certain gold, silver, platinum, and palladium coins, but nothing that derives its intrinsic value from collectability or scarcity. So who are disqualified persons from investing HSA funds with, meaning that you can't buy or sell anything in the HSA plan to one of these people? The HSA owner and their spouse, the lineal ascendants and descendants. It's a fancy way of saying directly up and down from you in your family tree and your legally married spouse. These are people you can't directly buy and sell things to, or a business entity owner controlled by a disqualified person as well. So investing your HSA in real estate. Real estate's near and dear to our hearts here at Advanta, and it's what a lot of people like to do with HSA plans. Not to say that you have to do this. You can certainly just treat it as a additional tax qualified plan that you have cash on hand to distribute from. And it's always good to weigh the options, especially when investing in something that is rather illiquid with funds that you might need to utilize for reimbursing medical expenses. So in this context, what is the investment look like? Heather wants to invest in real estate deals with others who buy, fix, and flip property. Heather has 20 grand in an HSA that is currently invested in mutual funds. And she thinks she'd make better returns investing in real estate, which with the current market for securities probably isn't too far off the mark. Steve's looking for an investment partner. Steve has acquired a property for rehab and needs 20 grand for rehab costs, then to sell. Heather offers to lend Steve 20 grand from her HSA and split the profit when the property sells. So what's this look like? So the loan amount's $20,000. The participation in the profits is 25%, and it's secured by a first mortgage on the property. The payoff is the total profits on sale are $30,000. So the tax-free income back to Heather's HSA is $7,500. So she invests $20,000 for 25% of the profits. Profits on the sale are $7,500 is how that plays out. Heather now has $27,500 in her HSA that she can use to pay qualifying medical expenses that she's incurred since starting the HSA, or she continue to grow her HSA through additional investments and take tax-free distributions in the future. So this is just a simple example of how someone has invested their HSA. There are all sorts of different and creative ways to invest retirement plan funds, and especially HSAs, and especially when looked at in the context of just how powerful HSAs are from a tax planning perspective, be it on the deduction side of things and the distribution side of things, they become very powerful indeed. So with that said, that kind of brings us right up to the end of our presentation time. If you'd like to learn more, we host bi-weekly events. We catalog all of these recordings on our YouTube page, and we maintain an up-to-date blog. If you're interested in getting started, remember that if you would like to establish an HSA, it needs to be done by the first day of the last month. So 12/1 is when you have to have the HDHP coverage established for you to be able to open up an HSA account. So the timeline is starting to tick on that. So if you'd like to learn more, or want to get some more, would you like to learn more or get some more information on exactly how these things work, feel free to reach out to me directly. If you'd like a copy of the slides, they are attached as a handout here. I do appreciate everyone being on with me today. I do enjoy this topic. Again, I do personally self-direct my HSA, so I really do believe in what I am teaching here today. I'm not just trying to be a talking head telling you about the benefits of something I have no experience with. So again, thank you everyone for being on with us today. I'll stick around for any questions that anyone wants to fire into the chat box with, again, the handouts attached. And thank you for joining us today.